Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy, and we enter the final days of the financial year end. On the global front, folks, Japanese core inflation hits 3% on YOY basis, continuing above 2% target for the 35th straight month. And although it's been lower than the previous month of 3.2% numbers on the backdrop of resumption of subsidies, it's still keeping the bets of rate hikes in action. On the other hand, BOE held the rate steady but was seen cautioning against the possible uncertainty from the whole tariff saga. China continues to be in a deflationary cycle with the recent consumer prices stating zero point 0.5, rather a fall of minus 0.7% in the Feb month. On the domestic front, the flows seem to be resuming with FII numbers showing positive updates. So, JK, with such sort of developments and the central banks struggling with the slowing growth and stubborn inflation, what's your take and how would we be closing the financial year?
Good morning, Shikhar. Uh, nice to hear your voice again. So, all the central bank this week, in fact, has been a heavy dose of central bank meetings, and we know we started with Fed meeting on Wednesday. Then we had the BOJ meeting just before that, Bank of England. All these three major central banks kept their policy rates unchanged. There were some forward guidance, but not that forward guidance were clearer on the economic projections, but not so clear on the monetary policy. That's very, very understandable. And in their own words, they look forward to a lot of uncertainty due to the policies of the new government in the US, and they do not want to pre-commit to any particular course of monetary policy action in view of the same. The only central bank that stood out was the Swiss National Bank. So they cut the rate by 0.25%. They brought the rate down to 2022 level, and that's a huge departure from what's happening with the other central banks. And of course, even they said that they've already cut enough and possibly look forward to no more easing from these levels. So that's the common thread running through all the central banks thinking that the Trump's policies would pose a lot of uncertainty. At the same, there's one more common thing that I'm observing that Fed called the possible inflation effect of Trump policies as transitory. Yesterday, ECB President Lagarde, they also in almost same so many words said that this could be temporary. The inflation impact of the Trump policies or tariffs could be temporary, but nobody's really clear exactly in what shape and form finally the tariffs would come in, and therefore they remain quite non-committal as far as the future guidance is concerned. And so that's you can say that it was almost a non-event as far as central bank meetings were concerned. Yes, Bank of Japan also, though the inflation is going up and very much supports a rate hike, they have also kept quiet and they remain non-committal. Ueda's press conference was very clear that they want to observe more data in the coming days. On the economic data front, yesterday weekly jobless claims, once again did not really reflect any sort of concern as far as the employment situation is concerned, despite all the talk of layoffs by the US government and cut down in expenditures of the government and all that. So the jobless claims have remained low in the well-known average range between 220 and 240. And so the 220,000 and 240,000. And so really no indication that something is going wrong seriously on the employment situation, at least, although we do have sharp slowdowns in the manufacturing sector. Even the Philadelphia Fed regional manufacturing index showed that the outlook is not so rosy. We also had the leading economic indicators that dropped to minus 0.3% was to minus 0.2 previous month. And yes, the outlook is a bit darkening. These are all surveys, but the real hard numbers are yet to reflect the same. That is the situation as far as the US is concerned. That's the reason why even the markets have stopped that sell-off that was happening, and we have seen 3 days of recovery in the US stock market, and of course they have been helped by a sharp fall in the yields. We are now the 2-year is now trading at 3.95%. 10-year is also fallen quite a bit just from prior to where it was in before the FOMC meeting. And Fed as well as the government of USA is quite happy about these falls because that is what they want. The lower yields, longer term yields, reducing the cost for the servicing the debt that they carry. And Trump lost no time in mentioning that, if inflation due to tariff is going to be transitory, Fed should be cutting rates. So he doesn't lose any opportunity to want a lower rate as far as the US economy is concerned. We did not have too much of other data from other economy. Employment situation in UK, of course, has been quite patchy. We did have unemployment rate still ruling at 4.4%, but the new employment was better. But overall, UK economy is facing a downward trend, minus 0.1% GDP recorded for the previous quarter, and the Bank of England downgraded the full year GDP also, in their latest assessment. So overall, currencies did not have too much to take away in the last few days, despite all the meetings and data that we have seen. In fact, what we're seeing also is dollar index slowly recovering. This I would put down to the fact that market has been selling dollars on the premise that your economy will sharply slow down, but none of the data so far has real data. I mean, real numbers have really not shown up. A slumping economy, more of it is on expectations and surveys. Therefore, the dollar suddenly finds itself a little bit oversold, and euro has dropped back by about half a percent or more, and steady there, and possibly can see some more profit taking. And also, one more point is that in as far as Europe also is concerned, the rise in euro has been prompted by a lot of expectations that eurozone economy will bounce strongly after the spending bunch that is going to come. But again, market will probably look at some real hard economic numbers of they really take the euro higher, because we already tested the key zone of 1.0950 to 1.10, that zone which is not broken, and some more profit taking in euro is possible. 1.0750 is possibly on the cards. Rupee, of course, really surprised many, because suddenly market is now looking at where RBI will come and support the dollar, from a situation where they were looking at RBI coming and supporting the rupee just a month back. So we are looking for bids. Market has been overwhelmed with the supplies. Of course, some of them also technical and position squaring due to NDF positions being unwound. Reportedly, there was an instruction from the regulator also to unwind. And of course, exporters getting a bit jittery after a fall of more than 1% in the last 1 week. Looking for rallies to sell. But whether it will continue, my own doubt is that, it will stay near 86.20, which is an important level. Of course, the much important level on the technicals is at 86.85, 85.85. But I expect these levels to hold. PSU banks probably will support the dollar at these levels. Also, there's an important development on OPEC side, where they've actually given some concession to the production increase that was announced 10 days back, which means that actually there can be some cuts in production among some of the OPEC countries, and that has actually seen the oil rise. So that's one factor that could be leading to the dollar getting supported against the INR. Yes, it's all down to flows. As you said, Shikhar, FII flows for the first time, some decent inflow has been seen after several days. More significantly, stock market has seen a rally of 7 days now, and that's significant. Sentiment is somewhat positive now. Yes, again, market would like to see how the post March, how the corporate numbers hold up, and of course how the economic numbers also hold up. So it's all a wait and watch, and watch for a real situation to emerge from the economic numbers. And in the meantime, market is just adjusting the excesses that has been done. While talking of excesses, I feel even the gold is looking at some sort of a tiredness around 3050 regions, and possibly seeing some profit taking, although no big sellers are coming in because of various uncertainties. It may stay in a range bound scenario of 3020 sorry 3020 and 3050 for the time being. So all in all, it's of course, thank God it's a Friday. We don't have too much of data lined up today, and we are closing in on the year end as far as India is concerned. So it will be more down to flows and some amount of PSU bank activity which can influence the market. Thank you.
Okay, JK, and yes, folks, I think we should be stating, thank God it's Friday with the kind of things happening around, but not much data to chew on in the past few days. Yes, indeed, there were a lot of central bank meetings, but I think, as JK mentioned, majority of the central banks have been watchful in their stance and being non-committal. Just like the forward guidance was much more clearer on the economic projections, but the actions by the central banks were not really that clearer. And even though the whole market is awaiting the cues from the hard numbers, the equity fall has taken a pause in the global markets, and so has been observed in the Indian markets as well. There's been a decent inflow, as JK mentioned, and we've observed, and there's been a rally of positive rally of last 7 days. So we can expect some sort of change in the sentiments for the short term. But overall, as we've been observing, the overall dollar fall has been from the fact that there's been anticipation of the slowing economy, but no real uh, cues by the real numbers. Gold has also been seen being a bit tired and possibly can trade in the ranged action. Overall, the narrative is being changed towards the inflation impact by the tariffs to transitory. Now, this is something that we need to see how things go about, because these narratives can change in a jiffy if they feel like. Let's see how things go about, folks. That's it for today, and thank you so much for joining in. It's been a great pleasure, JK, to be back with Almus Market Mornings. Thank you so much, folks.